All right, let's dive in. Today, we're going to venture beyond the usual suspects in your portfolio. We're talking about the more specialized, more complex instruments in the vast world of finance.
Look, you probably get stocks, you get bonds, right? They're the bread and butter. But the financial world is like an onion. It's got layers. And today, we're peeling back that first layer to see what kind of tools the pros are really working with.
So get ready. We're about to explore 4 really distinct investment vehicles. Each one of them is built to do a very specific job that a simple stock or bond just can't.
Yeah, you can think of these as the precision instruments in the financial toolkit, designed for some pretty unique challenges and opportunities.
First up on our list, structured products. Now, forget about your typical off-the-shelf investments. These things are more like custom-engineered financial machines.
So, how do they work? Well, it's all about the blend. They mix different financial ingredients, usually something safe, like a bond, with something a bit riskier, like a derivative. This allows an investment bank to cook up a product with a super specific goal in mind, like, say, protecting your initial investment while still giving you a shot at some of those sweet market gains.
Let's pull back the curtain on a simple one. Picture this. You invest £1,000. Now, most of that, let's say 800 quid, goes into what's called a zero-coupon bond. That's your safety net. It's guaranteed to grow back to your full £1,000 when it matures. Then, that leftover £200, that buys a call option, which is basically a bet that the market's going to go up. So if the market totally tanks, your bond saves your skin. But if it soars, well, that's when your option pays out. Pretty clever, right?
Of course, they're not all created equal. You've got 3 main flavors. Structured deposits are the safest. They're government protected and offer modest returns. In the middle, you have capital-protected products, which use that bond and option combo we just talked about. And then you have SCARPs. That stands for Structured Capital at Risk products. With these, the safety net is gone, or at least smaller. You're putting your initial capital on the line for a shot at much higher returns.
Okay, next up, the famous and often misunderstood world of hedge funds. Now, I know they have this reputation today for being these high-risk, high-reward gunslingers, but you know what's funny? Their original purpose was the exact opposite.
That's right. The clue is in the name. They were designed to hedge their bets. The original goal wasn't to hit a home run every single time, but to grind out steady, positive returns no matter which way the overall market was heading.
And that brings us to their core philosophy, absolute return. It's all about decoupling from the market's performance. You see, if the S&P 500 is down 10%, a traditional fund manager might be thrilled to only be down 8%. But an absolute return fund, its goal is to be positive, period. It's playing a completely different game. But playing that different game comes with a pretty unique price tag. You've probably heard of the classic 2 and 20 model. It means they charge a management fee, usually around 2% of your assets, just for showing up. And on top of that, they take a hefty performance fee, often 20% or even more, of any profits they make for you.
So how on earth do they try to pull this off? Well, one popular strategy is called market neutral. It's all about balancing your bets. A manager might buy shares in a company they think is a total bargain, while at the same time short-selling a competitor in the same industry that they think is way overvalued. The idea is to profit from their stock-picking skill, not from which way the market winds are blowing.
Then you've got the event-driven funds. Think of these guys as financial detectives. They're constantly on the hunt for profits from specific corporate events. Mergers, acquisitions, that sort of thing. When a takeover is announced, for example, they'll analyze the deal from every angle and place trades to capitalize on the tiny price movements, basically betting on the outcome of the event itself. And finally, there's global macro. These are the big-picture thinkers. They're not getting bogged down in the details of one company. Nope. They're analyzing massive global economic trends to make huge directional bets on entire countries, interest rates, or currencies. It's like investing based on geopolitics. Okay, let's switch gears to private equity. If the public stock market is the main event that everyone gets to see, think of private equity as the exclusive backstage pass. It's all about investing in companies long before they ever become household names.
So, what does that really mean? Well, in a nutshell, private equity firms give money to companies that aren't listed on a stock exchange. In return, they get an ownership slice of the company and often a seat at the table to help run things. The whole point is to fuel massive growth over a pretty long time horizon.
And when I say long, I mean it. This is a patience game.
The life cycle starts with the investment. Then comes the really hands-on growth phase. This can last for years, where the PE firm is actively involved trying to bulk up the company's value. And then finally comes the exit. That's the payday, where the firm sells its stake either to another company or through a huge initial public offering, an IPO.
And for our last stop, we're going to look at something truly fascinating called Sukuk. It's an amazing innovation that came out of Islamic finance to solve a very specific puzzle. How do you create a bond-like investment that doesn't involve paying interest, which is forbidden under Sharia law?
To really get it, you have to see it side by side with a regular bond. A conventional bond is basically a loan. It's a debt. You're lending money and you get paid interest for it. A sukuk, on the other hand, represents actual ownership in a real, tangible asset. Your return isn't interest, it's your slice of the profit or rent that the asset generates. It's a fundamental difference. Okay, so let's walk through how this works, using a common type called Sukuk al-Ijara. First, a company sells a real asset, let's say an office building, to a separate entity called a special purpose vehicle, or SPV. Then, that SPV issues certificates to investors like you, which basically makes you a part owner of the building. The SPV then immediately leases the building back to the original company. The rent they pay gets passed along to you, the certificate holders. That's your profit. And at the very end, the company buys the building back, which returns your initial investment.
So the absolute core principle here, the main thing to remember, is that the entire investment is anchored to a real physical thing. Your profit comes from the actual economic use of that asset, not from the simple act of lending money. It's a complete paradigm shift from how traditional bonds are structured.
So, we've explored 4 very different, very specialized corners of the financial world. After all that, what's the big idea you should walk away with? Here it is. These aren't just different ways to invest your money. They are highly specialized tools. Each one is precision engineered to solve a specific problem. Whether that's creating a very particular risk profile, trying to make money no matter what the market does, funding a company's growth before it goes public, or enabling investment without interest.
And that really just leaves us with one final thought. Now that you know about these tools and how they work, what kinds of problems can you imagine them solving out there in the real world? It's something to think about. Thanks for joining me.